We are back in the black hole of real estate, and a conversation that seems to be on just about everybody's minds right now is taxes and real estate taxes and your tax returns and how they might just have some relationship on how you make your next move. This is your host, Ron Wojciechowski, for the black hole of real estate. And yeah, tax time. Everybody is running around trying to get those taxes done. And, for many, they're hoping for a refund to have a little extra cash to do some home remodeling. Maybe it's a down payment for their first home, or maybe it's some money to allocate, towards another property, or maybe just a vacation. On the other side of that, many investors keep their money working all year long, and then they have to write a big check, depending if it's quarterly taxes, if it's the corporate taxes, March 15th. Are they filing extensions? Of course, April 15th, everybody knows about that day. So, if you got to pay in, the vast majority of people are waiting till right near that last minute to get it postmarked on April 15th or whatever the day is that you're filing for. But interestingly enough, the tax due, whether it's a refund or paying in, it's already baked in the cake. It either means you paid them too much all year long and you gave them an interest-free loan and now you get a tax refund. It's nice way to have a savings account, I guess. The other way is that you underpaid all year long and now the day of reckoning comes in on April 15th and then you've got to pay what you owe because you didn't pay it all year long. So, either way, it comes out to pretty much the same number. It's just when you pay it. Now, along this line, you start to identify certain things. Maybe you had a really good year and your tax bracket went a little higher than it was the year before. And then you pile on some real estate gains and they're taxed at a higher rate. So the real tax strategists are looking at this, all year long. And as they are earning money and selling things, selling homes that are profitable, and they have these taxes accruing all year long, there are some that would absolutely sell a home to close by December 31st in an effort to have a loss, yes, a loss, which would wipe out some of the tax due on April 15th. So there's savvy CPAs and tax advisors that are looking for ways to continue to pay less tax every year. And even if you sell at a loss, let's just say you close on December 31st and you have a loss and it wipes out all the tax that you have due, or a big chunk of it. You think, well, geez, why would I do that? Well, you've got the cash from the sale. And if it's a loss, if there's a remainder, look at, think of a scenario where you bought something for a couple $100,000, you end up selling it at $175. There's no tax due, but it was free and clear, and you got $175,000 in your pocket. That could be reallocated into something else. So you save the taxes, then you go into a different property or thing that you are going to own. Maybe you're buying and holding it and receiving rental income, which could be deferred over time, and you've got depreciation, which could factor in, so that could happen. But the power of that cash combined with the tax benefit, that could be a real thing to a lot of people. And if you want to kick the can further down the road with that new allocation, when it's time to sell, you could do, a 1031 exchange. And we've talked about those a lot, that tax-deferred exchange. And what that really is meaning is that when you sell that next property and you want to avoid paying the taxes, you could run it through your 1031 tax exchange intermediary, and you could adjust the taxes on a subsequent sale somewhere down the road. With all of these tax strategies and opportunities, tax time for me is it's kind of exciting because I get to work with so many people that are sharing, hey, so here's what I'm doing. I'm doing a 1031 exchange. We had one this week, and they identified the property, and for them, it's happened, boom, boom, boom. They're going to close in a couple of weeks' time. Now, it could be someone that's going to identify two properties within 45 days for their 1031 exchange and close at 180. That's pretty common. But, so they've got that working. A different person literally had sold something at a loss and told me the other day, I got a bunch of cash. How's that? I sold a property at a loss back in December. It's going to help me at tax time. And plus, I got some money to go invest in the next thing. So whatever was in play for where they were selling and taking a loss. What they felt was they can take that extra cash that they have in hand right now, put it in a different investment vehicle, in this case for them it's real estate, and get a bigger gain, more appreciation, and maybe some rental income along the way, which would make them whole on the loss that they took just a couple of months ago much faster. Instead of waiting for the market to come back in 5 or 10 years for that one particular property, they can get into something that will increase their cash flow, but also make up for that little bit of loss much faster. So again, it gets really interesting when you start to think about all the ways that you could somehow avoid taxes or pay less, get cash in your pocket to go make more, and then defer it down the road. This is where the smart money makers are having their field day right now. They're not afraid of tax time. They're embracing it because there's a new strategy every year. There's a new area, and you can call it a loophole, but really it's just tax strategy. If you know what the rules are and you're playing within the rules, and there's an advantage out there that maybe you weren't aware of and the next guy's not aware of, that's where the money's made. It's not how much you make at the sale. It's how much that you keep. And how much that you keep is the critical number. And plenty of people, I sold for X number of dollars. Fantastic. When it's all said and done, your acquisition and all the costs and all the renovations and the closing costs and realtor fees, was there anything left over? Okay, great. How much? And then after you paid tax on that money, was it worth the effort? Because for some people, they'll flip a house, by the time they pay everything, they make 5 or 10 grand over 6 months. And I got to think that there might be a better way to make money than that. I think having a buy and hold rental would provide more money over time than a skinny flip, if you know what I mean. And a few flippers out there, you know when it gets skinny. And sometimes if the market's going a little bit sideways, or perhaps you overestimated what the property would sell for down the road, or you underestimated what it would cost to get it repaired, or maybe it just took so long to sell it that your closing costs and the carrying costs just ate up whatever profit there was going to be. So tax time, real estate taxes, intertwining. We know what property tax is, and when people think, taxes and real estate, they're thinking about your property taxes. I mean, that's a thing. But really and truly, unless you're homesteading a property, or in Florida, you can use portability if you're moving from one place to another to keep that tax benefit. There's not a lot of ways to avoid real estate taxes unless you've got some sort of a grant or tax credit if you're working in an underserved area or a target area for a city or a county or a state. Then that would absolutely give you a little bit of tax credit. And people do that all the time. Maybe there's some preferred funding available for the renovations. Those are things that you could look at. Some has a recapture, so when you go to sell, depending on how long you keep the property, some of that could absolutely be forced, you may be forced to pay some of it back. But everything I've listed today are legitimate strategies and things that people are talking about just in the last week, in real conversation about real purchases and real sales. And it got me thinking this would be a great time to share this information with all of you, or, being in the reminder business that I am, maybe it's just reminding you of something that you already knew, but maybe had forgotten about, or just haven't used it yet. This could be that little bit of a push for you to give a second look at what your tax strategy is going to be for this year and the foreseeable future, and what effect real estate is going to have on that. And will you diversify into other things besides real estate? Is it stocks, equities? Is it the bond market? Is it precious metals? I mean, these things are all in play. I see a movement where people are moving out of some equities and some of the metals and back into real estate because there's opportunity out there. I think it ebbs and flows, and for those coming in, there's some moving out. But because there is activity and movement, and in some cases volatility, there's opportunities out there for profits. I think anybody that's trading in stocks would tell you that volatility can be a good thing, even though it's uncomfortable. The savvy Patient investors that are studious can do really well in that, and I believe it's the same thing for real estate. So if you've been studying the real estate market and you're looking for an opportunity to get in, we know where interest rates are. The way to negate that is through tax strategies, running the rent rolls. Chances are the rents will go up over time, and with the right strategies, when you go to sell, there's going to be even more profit for you down the road by putting the time in now. I hope that helped you with my session today on real estate and taxes, but not necessarily real estate taxes. And I look forward to our next conversation. This is your host, Ron Wysakarski, for the Black Hole of Real Estate.